FOB Free on Board. This is the last member of the F group, and as you see according to the diagram, the seller is supposed to carry the goods until the wharf, then do the customs clearance in the country of origin, then load the goods onto the vessel. The loading onto the vessel finishes when the merchandise is completely placed in its relevant area on the vessel. So the delivery happens when the goods are loaded on the vessel according to what I told you. A1 General Obligations. In each of the 11 rules, the seller must provide the goods and their commercial invoices as required by the contract of sale and any other evidence of conformity such as an analysis certificate or weighbridge document, etc., that might be relevant and specified in the contract. Each of the rules also provides that any document can be in paper or electronic form as agreed to in the contract, or if the contract makes no mention of this, then as is customary. The rules do not define what electronic form is. It can be anything from a PDF file to blockchain or some format yet to be developed in the future. B1 General Obligations. In each of the rules, the buyer must pay the price for the goods as stated in the contract of sale. The rules do not refer to when the payment is to be made: before shipment, immediately after shipment, 30 days after shipment, half now and half later, or whatever, or how it is to be paid: prepayment against an email of copy documents, on presentation of documents to a bank under a letter of credit or other engagements. These matters should be specified in the contract. As I told you before, Incoterms have been ignored for a long time since the people who do business were not aware of different aspects of effectiveness of these terms if they are used properly and correctly. So in order to help the business people, companies, or any identity who wants to do an international trade, it is essential to know the Incoterms and their effects on how the business is done and how a potential problem can be tackled using these Incoterms. So in order to have a smoother business process with less potential dangers and problems, you must be aware of the details in Incoterms, how to use them, and how to use them as a leverage to help yourself and your company. A2 Delivery. The seller delivers by placing the goods on board the vessel nominated or provided by the buyer on the agreed date, or within the agreed period as notified by the buyer. Or if there is no such time notified, then at the end of that period. There is still a belief that the ship's rail is the defining point. It means before the notional vertical line above the rail is the seller's cost and risk, and after is the buyer's cost and risk. A court ruled that the delivery point was when the goods were on the deck, but that then caused the question: was the notional vertical line replaced with a notional horizontal one in line with the deck itself, and what if the goods were being placed below the deck? The ship's rail concept was removed in the Incoterms 2010 version. Typically, then on board is taken to mean the goods are safely on the deck or in the hold. If the cargo needs to be then further secured for transportation, such as being lashed or separated with some material or spread evenly throughout the hold for bulk goods like grain, the seller and buyer should agree in their contract what is needed and at whose cost and risk this is done. FOB is mostly suggested for bulk products, at least fully containerized merchandise, and for LCL shipments it is not suggested because the seller is not directly involved in the loading process if it is an LCL shipment, because in LCL shipments the seller usually delivers the goods to the shipping company, which in this case is nominated by the buyer, and the shipping company puts the LCL cargo into a container and takes the container for loading onto the wharf. So, while in FOB the risk and responsibility and the cost of goods is on the seller until the loading is done on the vessel, the goods are not under the seller's control because the seller has already delivered the goods to the shipping company to be containerized and sent to the wharf for loading on the vessel. Because of that, FOB is not a suitable case for this type of cargoes. And for these type of cargoes, LCL FCA is much better than FOB. B2 delivery. The buyer's obligation is to take delivery when the goods have been delivered as described in A2. Actually, when we say take delivery in FOB, we are talking about an automatic procedure, because when the goods are supposed to be loaded on the vessel, then the buyer automatically takes the delivery because the goods are delivered by the seller by loading the merchandise on board. So, the term buyer accepting the delivery means the exchange of shipping documents such as bill of lading, the onboard bill of lading in the case of a letter of credit. But when it is not a letter of credit in the process and the amount of deal is paid beforehand, then the term defining the buyer accepting the delivery is meaningless. A3. Transfer of risk. In all the rules, the seller bears all risks of loss or damage to the goods until they have been delivered in accordance with A2 described above. The exception is loss or damage in circumstances described in B3 below, which varies dependent on the buyer's role in B2. B3. Transfer of risk. The buyer bears all risk of loss or damage to the goods once the seller has delivered them as described in A2. If the buyer fails to inform the seller of where and when the vessel will be presented, or if the vessel fails to arrive on time, or it fails to take the goods so that the seller cannot deliver, then the buyer bears the risk of loss or damage to the goods from the agreed date or at the end of the agreed period. According to the normal situation of the term, you can see that the transfer of the risk happens when the delivery happens. But in case when one of the parties takes an action or fails to take an action that violates this point, because of one party's action or failure in action, the other party cannot perform its duties, then the transfer of the risk point is violated and may vary. I want to talk about something which is not mentioned and which the Incoterms don't deal with it. And that is transfer of title. Transfer of the title is the point where the goods as a property of the seller shift to be a property of the buyer. This is not dealt with in Incoterms, but in international business it is important So I wanted to talk about this item besides our Incoterms lessons in order for friends to learn something about this important problem. As I told you, transfer of title or title is the ownership of the merchandise. So when the title shifts, it means that the ownership of the merchandise shifts from the seller to the buyer. Why is it important? First, title shift means that a transaction or a sales has been completed. So in matter of your documentations and your books, your financial books and financial transactions, transfer of title is very important. 2. When the title transfers or when the title shifts, the relation between the creditor, the one who has paid money to buy some goods, the merchandise, and the debtor who has received some money to sell some products will be clarified. So, if the title transfer and the title shift is not agreed, when the creditor affects the merchandise in any way, then if the debtor wants to go the wrong way, it can sue the creditor of doing tort. Tort is a financial and business term for theft. It means affecting someone else's property. And 3, if you buy an insurance and the title has not been transferred to you at the time something happens to the merchandise, then the insurance company will do its best not to pay you any compensation against the premium you have paid. So, what can we do and how can we deal with this title transfer? There are some ways. First of all, the point where and when the title shifts from the seller to the buyer or from the debtor to the creditor is to be agreed. The best one is to rely on Incoterms and nominate the time when and the place where the products are delivered. So we can say that according to Incoterms 2020, the title shifts at the time of delivery. This is one way. The other way is where and when the documents of title, such as a bill of lading or a receipt from the carrier, whatever, are delivered to the buyer, depending on the situation. And for special products such as softwares or intellectual products generally, where there is no physical product to deliver or no document of title like bill of lading, whatever, to deliver, it is the best that you put the title shift on the time where and when the contract is made. A4, carriage. The seller has no obligation to contract for carriage. If the buyer requests the seller, it must provide the buyer at the buyer's risk and cost any information known by the seller, including transport-related security requirements that the buyer needs to arrange carriage. If agreed, the seller must contract for carriage on the usual term, which are usually agreed in the contract or determined by previous dealings between the parties at the buyer's risk and cost. The seller must comply with any transport-related security requirement, but only up to delivery. B4, carriage. The buyer must contract for carriage from the port of shipment, except if it is agreed that the seller makes the contract of carriage as described in A4. Yes, in FOB, the carriage is on the buyer, but if the buyer requests the seller to arrange the carriage, the seller can do this on the buyer's risk and cost. But the risk transfers to the buyer at the delivery point, which is defined by the Incoterms. There is another problem which may arise in such a case. If the buyer asks the seller to arrange the carriage and the seller makes the contract of carriage, and if the merchandise goes to the port of destination and the buyer walks away from the deal for any reason, then the shipping company can sue the seller, which is in the contract, for any kind of demurrage or any incurred costs from this scenario. So, sellers who are selling FOB and also other terms which I will talk about them later on must consider these scenarios in the policy they apply when they want to receive the down payment. So when you want to agree on the down payment on your contract, please consider all these possible scenarios which may happen during the process. A5, insurance. The seller does not have the risk beyond the delivery point, so it has no obligation to the buyer to arrange a contract of insurance. However, if the buyer requests at its risk and cost, the seller must provide the buyer with information in its possession that the buyer needs to arrange its insurance. B5, insurance. Despite having the risk of loss or damage to the goods from the delivery point, the buyer does not have an obligation to the seller to insure the goods. Whether the buyer chooses to insure the goods or bear the risk themselves is entirely their choice. So the point that we have to say about this clause, this part of the story, is that it is true that the seller does not have any risk after the delivery point, but practically there are still some risks. Imagine that the delivery has happened and the shipping documents including the onboard bill of lading is delivered to the seller to take to bank and handle the payment scenario. But after the merchandise is delivered and gone on the sea, while the two banks, the seller's advising bank and the buyer's advising bank, are dealing with the documents to confirm the conformity of the documents, the buyer walks away and asks its advisors to find a non-conformity in the documents in order to cancel the letter of credit. So in such a case, if they find such a non-conformity to cancel the letter of credit, the merchandise is on the sea going to the port of destination, and the seller has to bear all the costs relating to returning the merchandise to its factory. So first of all, the best way to tackle such a risk is to buy insurance from the seller's warehouse to the buyer's warehouse and use the contingency insurance to cover such risks. A6, delivery transport document. The seller at its own cost must provide the buyer with the usual proof that the goods have been delivered in accordance with A2. Unless this proof is a transport document, then the seller must assist the buyer at the buyer's request, risk, and expense to obtain a transport document. In practice, it is often the seller who will arrange with the buyer that the proof is an onboard bill of lading showing the seller as shipper or consignor, or it can be a simple mate's receipt issued by the vessel's master. B6, delivery transport document. The buyer must accept the proof of delivery provided by the seller. First of all, I should tell you that in many cases, when the deal is done through a letter of credit, this delivery document, this shipping document, is the onboard bill of lading. Or if it is the road transport or rail transport, the CMR is the shipping document. But when the scenario is not a letter of credit or a draft, in which these shipping documents play an important role in collecting the amount of the deal, it can be any other thing. It can be any other thing agreed between the two parties. B6 says the buyer must accept the proof of delivery provided by the seller. This proof of delivery includes a set of important information, including the quality of products which has to be in conformity with the quality stipulated in the contract, and the quantity of the goods which has to be clarified by the seller and approved by the buyer. A7. Export-import clearance. This rule, like all the multimodal rules, is suitable for both domestic and international transactions. Where applicable, the seller must at its own risk and expense carry out all export clearance formalities required by the country of export, such as licenses or permits, security clearance for export, pre-shipment inspection, and any other authorizations and approvals. The seller has no obligation to arrange any transit import clearances. However, if the buyer requests at its own cost and risk, the seller must assist in obtaining any documents and/or information which relate to formalities required by the country of transit or import, such as permits or licenses, security clearance for transit or import, pre-shipment inspection required by the transit import authorities, and any other official authorizations or approvals. Yes, in FOB, the export formalities in the country of origin is on the seller, but if these export procedure needs a document or any kind of authorizations from the country of destination, and the buyer fails to deliver these kind of documents on time to the seller, then any delay in custom clearance process or any consequences will be on the buyer's liability. B7. Export-import clearance. Where applicable, the buyer must assist the seller at the seller's request, risk, and cost in obtaining any document and/or information needed for all export-related formalities required by the country of export. Where applicable, the buyer must carry out and pay for all formalities required by any country of transit and the country of import. These include licenses and permits required for transit, import licenses and permits required for import clearance, security clearance for transit and import, pre-shipment inspection, and any other official authorizations and approvals. They are the buyer's responsibility because they occur after delivery by the seller. At first glance, it might seem strange that both seller and buyer have responsibility for the pre-shipment inspections. To clarify, the seller is responsible if it is a requirement of the country of export, and the buyer is responsible if it is a requirement of the country of transit or import. A8. Checking, packing, marking. In all rules, the seller must pay the costs of any checking operations which are necessary for delivering the goods, such as checking quality, measuring the goods and/or packaging, weighing, counting the goods and/or packaging. Let me add something here. In cases where the buyer does not trust the seller, then the inspection companies will take the role of checking these items, and in this case, the cost will be on the buyer. Next paragraph. The seller must also package the goods at its own cost unless it is usual for the trade of the goods that they are sold unpackaged, such as in the case of bulk goods. The seller must also take into account the transport of the goods and package them appropriately, unless the parties have agreed in their contract that the goods be packaged and/or marked in a specific manner. B8. Checking, packaging, marking. In all rules, there is no obligation from the buyer to the seller as regard packaging and marking. There can in practice, however, be agreed exceptions, such as when the buyer provides the seller with labels, logos, or similar. Yes, and also if the buyer asks the seller to use a special packaging for the products which is above the standard export packaging, then the buyer will be liable for the expenses. And if any required items such as labels, logos, or similar things come late and they delay the delivery, any customs or warehouse costs, any delays, any demurrage, whatever will be on the buyer. A9. Allocation of costs. The seller must pay all costs until the goods have been delivered under A2. meaning alongside the vessel for FAS, and loaded on board the vessel for FOB, except any costs the buyer must pay as stated in B9. The seller has to pay any costs involved in providing the usual proof that the goods have been delivered. So if the contract between the parties states that proof as being a bill of lading, then any document fee is on the seller. The seller pays any costs, export duties and taxes where applicable, related to export clearance. If the buyer is requested by the seller to provide information and the documents to assist the seller in the export formalities, then the seller must pay the buyer for these costs. Yes, as we mentioned before, if the seller needs some documentations from the buyer to export the documents and the buyer fails to send them on time, any demurrage will be on the buyer. And if the seller asks the buyer to send such documents, any costs related to this delivery will be on the seller. B9, allocation of costs. The buyer must pay the seller all costs relating to the goods from when they have been delivered, other than those payable by the seller. If the seller has been requested by the buyer to provide assistance in obtaining information or documents needed for the buyer to effect loading on board, carriage, import formalities, insurance, and the transport document, then the buyer must reimburse the seller's cost. Where applicable, the buyer pays any duties, taxes, and other costs for transit or import clearance. Additionally, and provided that the seller has advised that the goods have been clearly identified as the goods under the contract, the buyer pays any additional costs incurred if the buyer fails to nominate the vessel, or the vessel fails to take the goods from the seller, or closes the cargo earlier than when the buyer notified the seller. A10 notices. The seller must give sufficient notice to the buyer that the goods have been delivered, meaning loaded on board, or that the vessel failed to take the goods within the time agreed. Such a failure could be, for example, where the agreed delivery period was March and the vessel arrived in the load port on 31st of March, but only allowed loading on 1st April. B10 notices. The buyer must give sufficient notice to the seller of any transport-related security requirements that apply after loading of the vessel and the vessel's name and loading point within the port of loading. These would usually be specified in the contract. We have mentioned this item before, but as we told you before, in case any of the parties fail to deliver these notices to the other party and any cost incurs, the party who has failed to do its own responsibilities will bear the costs. Let us talk about some points to keep in mind about FOB. FOB is widely used but mostly used while many users do not have enough information about the term. Please keep these in mind. 1. FOB is a term for waterway shipments. I have seen some cases where FOB was used for an on-road transport. I remember I heard about a deal between an Iraqi business person and a Turkish business person. The merchandise was dealt based on FOB Ibrahim Khalil Customs House in Iraq, which is a roadway. And there was some difficulty in solving the case in the customs based on the documents. What happens if the FOB term is chosen for road, rail, or air shipment? According to ICC, FOB means free on board, named port of loading. So if you choose a term such as FOB London, then there is no port in order for the requirements of the term to be accomplished and the delivery does not happen. Then there is no port, and the question is that after which point the shipping cost is on the buyer. In such cases, there will be a long and corrosive way to go to the courts. 2. FOB is not suitable for containerized goods since the seller hands the goods to the carrier once in its place for putting them in a container and once again after the seller has finished the customs affairs. Even if the goods are loaded on an FCL full container load and put in the container's yard, this is the container which is loaded and delivered, not the goods. Looks a bit weird, but bad guys can use it to reap your money. I have mentioned this item before also. If you remember, we talked about handing in LCL goods in order for the carrier to put them in a container and do the export formalities. So especially LCL goods must not be dealt with on FOB term, and you better choose FCA instead. 3. There is a version of FOB which is called FOB destination port. It is said that this term increases the responsibility of the seller against any damage to the goods up to the port of destination to cover such a deficiency in CPT, CIP, CFR, and CIF. But this term, FOB destination port, does not exist in ICC Incoterms and is not eligible to be discussed in any court. So please stay away from these kinds of terms. In many cases, customers ask the seller to give them an FOB price. The items to include in such quotation are the price of the goods in the warehouse, finished price the cost of sending the container from your place to the port of loading, domestic container rate, the custom declaration fees plus VAT, but many countries are VAT 0 rated for exports, plus THC, terminal handling charges, plus cost of security declaration. The police brings a dog to sniff for drugs and the dog has a salary, whatever. The cost of special shipping documents such as a CO, certificate of origin, if required by the buyer. 5. FOB extended. This is a version of FOB in which the seller is committed to arrange the shipment and insurance up to the named destination port. It all depends on the buyer and the seller to include anything they want in their contract. This is due to the freedom nature of any contract. But as the buyer and the seller may have information deficiency about what might happen as a side effect of choosing such terms of delivery, this term of delivery is not advised. FOB legal cases. There have been many legal cases. In most of them, the problems have been a misunderstanding about the point of risk and title transfer. So, in order to avoid such misunderstandings, you must clarify two things in your contract. 1. Where the risk of damage is transferred, which is the place and the time where the delivery has happened in FOB, and where the title ownership is transferred. As you remember, previously we talked about this item and you have to agree this in the contract of sale.